And as Naren joins us now, let's talk markets and let's talk about valuations and how should one be investing in this kind of a market. And Naren, fantastic to have you back. Thank you for joining us. Naren, I'll start with something very simple. What is your current market view?
Actually, it's not a very easy area from the point of view of equity market view, because see, you're talking about roughly 45 days ahead of US elections. There has been a big melt up in US FANG stocks, and after that, FANG stocks have seen a meaningful correction in the recent past. I would still say, even after the US FANG correction, many of the US stocks are still meaningfully overvalued. So we are headed for a period of volatility actually globally. If you look at the Indian markets, you have, as you correctly pointed out, pre-market, we have a two-type market. You have one set of stocks which keep going up regularly, another set of stocks which keep going down regularly. So you have a very funny situation where you don't know which side, what to say about the markets, because on one set, every day the price to earnings, the dividend yield, price to book, everything looks cheaper and cheaper and cheaper by the day. And another set of stocks where everything looks costlier and costlier by the day. And will that diverge? Will that converge? Because over the 30 years that I have been in the markets, I've seen that one day they suddenly converge. But there have been periods like 98, 99, 2006, 7, where these divergences have continued for some period of time only to finally converge. So that is a tough job. So I think we are headed. The good thing is we have seen everyone make money. Particularly retail investors who entered the market in April. So at least you are talking at a time when everyone has made money in equity markets, by and large, except that the people who follow valuation models like price to earnings, price to book, dividend yield. So anyone who does not follow any valuation models have genuinely, surely made money. And in general, people have also made money because everyone buys a basket of things. And in that basket of things, something works. So it's, I would say, not very easy to say what is the market view.
Well, Dr. Reddy is up another 3.5%. That takes Dr. Reddy to 5,500. Naren, so how are you investing in this market? One side, you got a compulsion of risk management. You cannot buy a stock like Reliance more than 10% because of your mandate. On the other side, you got a benchmark to beat. How are you managing your portfolios at a time when, for a large institutional investors like you, this market is very narrow, and the smaller cap market where the action has started, you cannot go because of your size and because of your constraints?
Basically, there are famous statements that every global investment guru says that, you have to take pain. So we are currently in the process of taking pain, because I think that, finally in the long run, the markets are rational. And, you can't have a situation where only technology and pharma stocks keep going up. And that also cannot happen, frankly, at a time when deposit rates keep going down, liquid fund and overnight fund gives you just 3% return. Why should stocks which give you 7 and 8% dividend yield keep going down every day? So I don't think that is also logical. So I think eventually markets will be rational. That is what all the investment gurus like Benjamin Graham have said. On the other hand, there are gurus like John Maynard Keynes has said that markets can stay irrational and for long till you are insolvent, and that is another thing. And Chuck Prince has said you have to keep dancing while the markets are irrational. So you have a number of investment gurus making very good statements. And that is a challenge that, you have to stay rational, because mutual funds are long-term investment vehicles. So if you look at credit, for example, There were periods of irrationality in 2017-18 where people said all that mattered was yield to maturity and risk did not matter. Suddenly in 2018 to 20 period, risk played out, and then the higher the yield to maturity, those things got into trouble. So today we have a situation that the higher the PE, the higher the price to book, nothing seems to matter in many of the stocks. So we will go through these phases. So if you look at something completely outside our domain, a stock like Apple has corrected from 135 to 108 in no time. And I believe that, we have a job of looking after investors in the very long run. So if you look at investments on a point-to-point basis, I think there is a problem. So if we had looked at investors in 2007 December, there were schemes of ICICI Prudential which were not doing well. It was those very schemes which we had looked at in 2009 December which had become doing well. So if you had looked at it on 31st December 2007, you would have thought that they were very, very bad schemes. And if you had looked at 31st December 2007, the schemes which are doing extremely well, many of them did not do well as on 31st December 2009. So I think finally at the end of the day, luckily I work for a mutual fund. I don't work for a hedge fund. And my goal is to look after the investors of India in the long run and not look at it on a point-to-point basis. So I have to respect long-term investment techniques and not short-term investment techniques. At the same time, I have to be aware, is the world changing? How is the world changing? How do I look at investment in a world which is changing? For example, in the last 6 months, we have been working out of home. How have things changed? We are so much more dependent on technology to get our work done. So there are a lot of other things which you have to keep thinking about because we are not in a continuous world where everything is static. We are in a dynamic world. So we have to keep thinking about that also at the same time. So while we have to think about investment techniques, which have been there for a long period of time, we have to think about a changed world also. But when I see stocks like Snowflake and Lemonade and DocuSign and Nikola and Tesla, it is really interesting to watch what is happening in the world. And at the same time, I've seen such periods of what I call irrationality and maybe the world calls rationality in 2007 and 99. So there are times when a lot of things have changed dramatically only to converge. So it's a very interesting period. And of course, it gives me sleepless nights. It gives me a lot of time to think. And I have to keep thinking whether I'm wrong and where do I have to change and what do I have to do. I have to keep thinking about all these things.
Naren, with all due respect to all global gurus, and of course their stature is much higher, they are successful in their own right, their views are also changing. Buffett has done things which he's never advocated in the past, which is buying technology companies, investing in an IPOs. Both of us tracked the commentary of Howard Marks. Look at how he's changed in last 6 months in terms of his market view and assessment of the cycle. So with all due respect to all the global gurus who in a sense were bearish, skittish, quite concerned post-COVID about what will happen to equity markets, their views are getting challenged and they themselves are changing their thought process.
While that is true, the reality is that we are in a developed world central bank bull market. And you have to recognize that we are in a 0% interest rate environment. And in a 0% interest rate environment, there are a lot of things which become very interesting in the Western world. Because if the Fed chair comes and tells you for the next 3 years, I'm going to keep interest rates at zero, there are certain things which do become very different from what it is before. So I think the world is also adjusting itself to a developed world central bank bull market. And even in India, we have seen one of the lowest interest rates on short-term rates ever that we have seen in my investing career. So I think we have to recognize that we are in a developed world central bank bull market. And what is interesting is we have spent a lot of time trying to think of what do you do in a developed world central bank bull market. We think there is a requirement to be in equity. We believe there is a requirement to follow asset allocation. We believe there's a requirement to have some position in gold. We believe there's a requirement to invest in debt. We believe there's a requirement to invest a certain amount of money in global markets. And we believe that it is not wise to say today is the day to make your equity zero. And I think these are the things that we learned out of repeated discussions on what is a developed world central bank bull market means. Because while you may have a US presidential election, developed world central banks don't have to face elections. They don't have to go through a situation where if I underperform for a few months, my money will be taken out. So these kind of things don't happen, and that's why I think we went through a lot of discussion to arrive at these views. And I think global gurus are also learning that there is zero interest rate with credit spreads being so low is something that they are also seen in such an extreme way for the first time. So you have to also give it to them. And you have to also remember that many of these investments like Warren Buffett and Apple, they were not made just now. Bulk of it was made much earlier. And if you take an investment like Snowflake, I don't think Warren Buffett made it at $200. He made it at a different price point. So you have to also remember what is the price at which they bought and what is the price at which the market is today pricing things. So I think it's very interesting. And one thing about investing, everyone makes mistakes. And this is not arithmetic. That's what I keep telling everyone, that this is not arithmetic and we all have to keep learning. And this is a continuous learning business, and we have to keep learning and we have to keep thinking and we have to keep aligning our learnings. But at the same time, there are certain core investing techniques which we have to keep remembering, and that involves a focus on cash flow and intrinsic value, which has to be kept in mind at all points of time. And that we have seen also. If you look at the entire credit fiasco which happened, that was based on the fact that some of the simple logics that had to be kept in mind got forgotten, and it played out suddenly. And like that, when you forget core investing techniques, they will suddenly play out, and they have played out in the past. They played out in 2008, they played out in 2000, and they can again play out. So I believe your goal of a mutual fund, fund manager or a CIO is to be disciplined. Because as I mentioned, we are not looking at point to point, we are looking for the long run, and we have large sums of money where we have to look after investor interests in the long run. And that is why we wisely decided that we have to look after through an asset allocation kind of framework rather than just a pure equity kind of framework, because pure equity goes through the problems of February, March, where suddenly out of the blue, you lose 20% of customers' returns. And whereas in an asset allocation framework, the losses that investors suffer are much, much lower. And therefore, we give a much better investor experience through an asset allocation framework. And that is what we have tried to do to all our customers in our country through our products.
Talking about that, Naren, the ESG fund, let's talk a little bit more, on that, and the kind of, the kind of factors that you keep in mind while putting that together, how it's doing as well. Because, in fact, in terms of what you're anticipating, given that the Nifty 100 ESG index has actually now completely recovered, share with us a little bit more about the thought behind this.
I think ESG is a very powerful investing framework which has got created over the period, particularly led by European investors. And given that environment, social and governance factors play a big role, you have to remember that equities as a class, we get the residual returns. The residual returns after what is due to employees, after what is due to the bondholders, after what is due to government. It is the residual returns which go to the equity holders. So when you actually use the ESG framework, and given that actually the owners of the stocks get the residual returns, when you actually use the ESG framework, you're actually ensuring that you're actually giving it to people, to the residual owners. So therefore, we think that the ESG framework is something which helps the residual owners, the equity holders. So, and I think the Europeans have actually given a lot of thrust to this, and through that they have realized that it actually gives a very good long-term investment framework for long-term investors, because at the end of the day, if you look after the environment, if you look after social factors, and if you look after governance factors, you're automatically going to take care of the residual owners, the minority shareholders. And therefore, what happens is the minority shareholders are going to gain very significantly in the long run. And that is how we have come up with this. And I think, this is going to be a category which is going to gain traction over the next few decades. And it is something which we thought there is a good opportunity to raise money. And the timing of the launch was primarily because the markets have recovered. But we thought that given that in the month or so following the launch, we have huge volatility potential due to the US election. The deployment period would be a period where you have massive volatility, so positive potential. So we get an opportunity to deploy into volatility in stocks where we think that the long-term potential is good due to ESG factors. And we spent time to understand how we can look at E, S, and G factors in many of the stocks, which my colleagues have been focusing on in all the stocks that we cover. That's how we look at it. So I think it's a very good long-term investing framework, and people have to think long-term in this category. We get a chance to deploy during a period which I think will be volatile because of the US elections. That's how I look at it.
Naren, you've already kind of touched upon various aspects of the way you're looking at the market, the volatility, thinking more long term. We've been asking a whole lot of our experts their mantras on getting rich. So given that it's particularly important at a time like we're in now, to keep in mind some solid investing strategies. If you had to coin it in a couple of minutes, what would be your advice to investors?
No, I think you have to remember equity investors are residual risk beneficiaries. So I think that's why we think ESG is the right way to go. Timing is, we need periods of volatility to make. You know that in the month of March was one of the best times to invest because there was so much volatility. We always believe volatility is one of the best times to invest. And that's how we look at it. And we spent a lot of time looking at governance factors. We've spent a lot of time looking at social and environment factors. And I think this is an area where we keep learning also. It's not that learning is complete. We have more learnings to do. And that's how we look at it. And I believe that the markets itself is not in a very, very easy frame of investing at this point of time. But at the same time, there are areas where we think there are a lot of long-term investment opportunities at this point of time. And there are areas which look fully valued at this point of time. And we really like the way both retail and institutional activity has been both involved. Unlike periods of time in the last 10 years, when it was just institutions who were active and retail was not active, whereas now we have an environment where everyone is active. And that is something which I really like at this point.
Naren, just an extension to the point that you were earlier making to Nikunj's question, the fact that the market is a rational beast in the longer run and you don't believe that this IT and pharma outperformance is going to stay for a very long time to come. If you had to deploy the current market scenario, which is so polarized in nature, skewed heavily in favor of one Reliance, a couple of other platform companies and largely pharma and IT, where would you be a contra buyer right now?
See, I think my view is that just do fundamental analysis and look at where do you think earnings are today underappreciated in the system, and you find a wide variety of things at this point of time. And frankly, it is only a narrow set of stocks where you find that earnings have been fully valued at this point of time. So you have a wide variety of companies, and it is across sectors, and it is just that the deployment strategy has to be more gradual, because it is true that there are sectors which have done well where the near-term outlook looks very good at this point of time. And there are sectors where the long-term outlook looks very good at this point of time. So I believe that where the near-term outlook is good at this point of time, you slowly take out money, because you have to accept that we have gone through a very difficult period due to COVID, which has benefited many of the near-term outlook sectors, like, for example, technology and pharma. And you can't at one point of time take out all the money from the sectors where there has been a near-term outlook benefit, whether it is e-commerce, whether it is technology, whether it is pharma, and pull that money into sectors which will do well in the long run. So I believe that that process has to be more gradual and it has to be more nuanced. Having said that, the level of valuation differential is so large at this point of time that there are very interesting opportunities across a wide variety of sectors. And it is not just limited. I would say that if you did a simple check and looked at stocks, where what is the price to earnings, what is the price to book, and what is the dividend yield based on 2020, you get a wide variety of stocks. On the other one hand, you have an average Nifty P apparently of 37. And you have a number of stocks which are trading at a price to earnings of less than 10. So just imagine what kind of a variance you have at this point of time, giving you a lot of margin of safety for investing in the long run.
Sure. Naren, just looking at that one underperforming pocket of the market with the largest weightage on the indexes, and that continues to be banks. The moratorium and the following NPA concerns clearly seem to be a big overhang. But do you believe right now is the time to start nibbling in and adding positions across the banks? And if so, where would you find opportunities within banks? Would you say stick to the top 5 names, or could you also look at bottom-up stories?
I mean, we had we've been giving a communication that this is the time to start SIPs and systematic transfer plans into banking funds. And this is not an area which we have rarely communicated, because we think that this is the time to start moving. Having said that, it is clearly in the top 5 or 6 banks at this point of time. Because I think the way the market is getting evolved, it is also the amount of capital that has been raised by the top 5, 6 banks at this point of time gives them disproportionate capability to handle any problem that may arise in the post-moratorium phase. So I believe it is going to completely focus on the top 5, 6 banks. And I think it is clearly time to start nibbling and a continuing basis starting now. And that is why we think that there is a good opportunity to invest in SIPs in banking and financial services at this point of time. And we think, just like we've been recommending value-oriented strategies or these kind of investments at this point of time, along with asset allocation strategies, we clearly think at this point of time there is a good opportunity.
Naren, I was looking at a very interesting tweet from Mr. Uday Kotak, and he spoke about what were the 10 top financial institutions in 2010 and where they are. And guess what? Platform companies which offer financial services have completely taken over. So our market's also telling you something like this, that look, finance is important, but the way you would be financing in future would be very, very different. Everything is morphing to a digital platform business. Is that something what markets are also telling you? Because banks are suddenly underperforming. Even though banks are attractive, the price to book value argument does not hold true even for something like an ICICI Bank or SBI for many years now.
I think if regulation makes it very easy to do many things, maybe it can happen. I don't know. I'm not the expert on this area, but I believe that in India, I believe even today, if you look at the public sector banks, they command a very, very large part of the deposit market share. So I think if you look at insurance, even today, LIC is a very, very large part of the insurance market share. So I think in a country like India, overnight, you're not going to see that big a shift as what everybody would like to. So I think the outlook for the top 5, 6 banks continues to be extremely good at this point of time. And everything cannot become a platform. I do believe, yeah, of course, there is going to be a very successful launch of an IPO in the near term, which will actually have a lot of discussion on this issue because of the IPO, which will get done maybe in the next 1 month. But I still think that the outlook for the top 5, 6 banks over the next 5 years does look pretty interesting for systematic investment.
Very quickly, globally there are Robinhood traders. In India, there's a surge in demat accounts. Now, historically, a sophisticated institutional investor has always raised concern about what is happening in the retail space. But do you think this time we should not disregard the kind of understanding and the kind of value what suddenly retail investors and retail traders both locally and globally bringing on table?
I don't think so. I think basically if they are disciplined, I'm very happy. And today they have been pushed into this area also because interest rates have been very low. So they feel that they should consider this area at this point of time because the interest rates are very much lower at this point of time. So I think, yes, I would say that they are not, even today, I would say bulk of them. And, SEBI has been very proactive in ensuring that too much trading doesn't happen and too much leverage doesn't happen in this area. And if you see, there has been a tightening of norms on September 1. Apparently, there is another set of tightening which is happening on December 1. So all these things are playing a role at this point of time. And consequently, I would say that there is clearly that all that is going to also make a difference and ensuring that even retail investors will stay disciplined without too much leverage at this point.
Naren, thanks so much for joining us this morning. Good chatting with you.